Have you ever pictured that moment? You know, that real feeling of financial freedom, maybe built on like smart moves in the stock market. It's a pretty common dream, isn't it? We all want our money to work harder. But here's the weird thing, the paradox. If it seems simple, why do so many people, well, end up losing money instead? Too often, I think it comes down to repeating the same basic investing mistakes, kind of like hitting reset, but in the wrong direction. So today on the deep dive, we want to offer you a bit of a shortcut. Not, secret tricks or anything like that, but a real understanding to help you avoid the most common pitfalls. Our mission really is to give you practical knowledge so you can navigate things more wisely. We've done a deep dive into, well, tons of investing advice and pulled out the top 10 mistakes. Mistakes beginners make, sure, but honestly, even experienced investors fall into these traps sometimes. We'll break each one down, offer some clear, maybe surprising insights, and show how just sidestepping these errors can almost automatically improve your returns. The goal is clarity, moving you from feeling confused to feeling confident, ready to act, no matter your technical background.
It really is remarkable, isn't it? How often these same patterns just repeat year after year. And like you said, these aren't some obscure, complex financial derivatives causing the problems. They're fundamental missteps. Often they stem more from, well, our emotional reactions than from logic, fear, greed. If you look at the big picture, mastering the don'ts is often way more crucial than chasing the latest do's. Really understanding these common mistakes can be transformative for anyone's investment journey.
Absolutely. So with that, let's dive right in. The first major pitfall. It seems so basic, but wow, so many people skip it, and it really sets the stage for almost everything else. Investing without clear goals, it's one thing to say, yeah, I want to double my money. Easy to say. But have you really thought about when you need it? Or why? What's the actual purpose? Without that destination, your investing is kind of adrift, like a ship without a rudder. What happens when the market dips or surges? If there's no goal, it often leads to, well, emotional decisions, panic buying when things look hot, or worse, panic selling when they drop.
That's a really crucial point. When investments aren't anchored to something specific, decisions become reactive, not strategic. The solution sounds simple, but it's powerful. Define your goals, be precise. For something short-term, maybe a car down payment in a year or two, safer things make sense, fixed deposits, maybe certain debt mutual funds, things invested mostly in government bonds, more stable stuff. But for the long haul, retirement, buying a house way down the line, kids' education, equity usually makes more sense there. Different goals just need different timelines, different approaches. Tailored.
Okay, tailoring the investment to the actual goal. Makes sense. And often, not having those clear goals leads straight into the next mistake. Following tips and hype. We've all seen it, right? Everywhere. Social media, chat groups, even some news channels, constantly pushing what they claim are surefire stock dips. But I mean, just think about it for a second. If a stock was really guaranteed to skyrocket, would someone truly be giving that golden ticket away for free online? Probably not. We saw examples like with Yes Bank in India. People lost a lot of money chasing the hype around those shares. It's a classic trap. Devastating.
Yeah, it happens over and over again. The core issue, like I said, is just a lack of independent checking, critical thinking. The antidote is, well, it's work, but it's necessary. Do your own research. Really understand the company's financials, the industry. Now, if you don't have the time for that, or maybe the expertise, and that's okay. A much safer approach is investing in broad market index funds or well-managed mutual funds. You can do this easily through a systematic investment plan, an SIP, just investing a fixed amount regularly. Because the instant diversification, professional management, you sidestep the whole risky tip-chasing game.
That's super practical advice. Okay, now this next one, it's really tempting, but also incredibly risky for most people. Mistake number 3, trying to time the market. This is like the holy grail, isn't it? Everyone dreams of it. Buy at the absolute bottom, sell at the very top. But the reality, and our sources are really clear on this, is that nobody, not even the pros, can consistently predict market moves. Not accurately. Think back to the 2020 crash. Lots of people thought, oh, it's going way lower. And then what happened? The Nifty, India's main index, recovered and actually doubled within a year. It's kind of humbling. The market often does the opposite of what everyone expects.
Right. So the crucial question is, if timing the market is basically, a fool's errand, what can you do? The answer, it's about consistency and having a long-term view, a steady hand. Instead of guessing the peaks and valleys, just invest regularly through SIPs. This strategy, rupee cost averaging it's called, means you invest the same amount each time. So when prices are low, your money buys more shares or units. When prices are high, it buys fewer. Over time, this averages out your cost. It smooths things out, takes a lot of the emotion out of it, and really rewards patience.
Rupee cost averaging. Simple idea, powerful effect. And that actually leads us nicely into mistake number 4, a complete lack of diversification. Just imagine putting, I don't know, every single egg you own into one basket and then whoops, you trip. That's kind of what happens when you pour all your money into just one stock, or maybe a tiny handful. We've seen those cautionary tales. Kingfisher Airlines, for example, in India, investors who put everything there, watched it all just disappear. Diversification isn't just some fancy finance term. It's fundamental. It's your safety net, a shield against the unexpected.
And it's worth pointing out, diversification isn't just about owning different stocks. It's spreading investments across different sectors and even different asset classes altogether. A really balanced portfolio might have stocks, yes, but also bonds, maybe some gold, perhaps even real estate. All, of course, tailored to your own risk tolerance and your goals. The beauty of it is if one area, say tech stocks, has a downturn, maybe bonds or another sector holds up or even does well, it cushions the blow, makes the whole ride much smoother, less volatile.
Smoother ride. Definitely appealing. Okay, mistake number 5. This one gets overlooked sometimes in the rush to invest. Ignoring the importance of an emergency fund. Sounds basic, right? Obvious even. But lots of people, they're so eager to get those market returns. They put every spare cent into investments without building that safety cushion first. Then life happens, as it always does. Job loss, medical bill, something unexpected comes up. And suddenly they're forced to sell investments. Often when the market's down, locking in those losses, painful. The COVID pandemic really brought this home for a lot of folks, didn't it? People had to sell shares at a loss because they just didn't have other cash available.
This is absolutely critical for long-term financial health. That emergency fund is your personal safety net. Its whole purpose is to stop you from having to raid your long-term investments at the worst possible time. The solution is straightforward. First, build up enough easily accessible cash, enough to cover, say, 3 to 6 months of your essential living costs. Keep this somewhere super liquid, a regular savings account, maybe a liquid mutual fund. You know, those funds that invest in very short-term things, easy to access, generally stable. Only after that foundation is solid should you really start thinking about making those bigger long-term investments.
Build the foundation first. Got it. Okay, mistake number 6. This is a common psychological trap. Short-term thinking. We live in this world of instant gratification, don't we? And that feeling, that desire for quick results, it often bleeds into investing. That urge to double your money in just a year, it's often just greed talking. And frankly, it rarely works out long term. You might get lucky short term, sure, but real, lasting wealth, that's built slowly, patiently, over many years. Look at Warren Buffett, probably the most famous investor ever. He made the vast majority of his fortune after he turned 50. Why? Incredible patience, a clear, long-term vision.
Exactly. And if we connect this to the bigger idea, the power of compounding. Einstein supposedly called it the 8th wonder of the world, right? It absolutely needs time. Years, decades even. For stocks, equity investments, you really should be thinking minimum 5 to 7 years, minimum. The longer you stay invested, the more time your money has to grow, and then the growth starts growing.
Yeah.
That's compounding. It also smooths out the bumps, that short-term market noise, lets you capture the real long-term economic growth.
The magic of compounding requires patience, though, which brings us to a related issue. Sometimes a little success leads to mistake number 7, overconfidence and overtrading. You know that feeling. You make a couple of good trades, make some profit, and suddenly you feel like, hey, I've got this figured out. I'm a market genius. This often leads to trading too much, buying, selling, constantly churning the portfolio, overtrading. But all that activity, it doesn't just potentially hurt returns, it definitely racks up costs. Brokerage fees, taxes, they eat into profits. And here's a stark reality check from our sources. Something like 95% of intraday traders, they lose money. People trying to buy and sell within the same day. It's just an incredibly tough game to win consistently.
Right. So the challenge is, if actively trading like that is so hard, what should you focus on? The solution is pretty clear. Treat trading, if you do it at all, as maybe a small secondary thing. Your main focus, your core strategy, should always be long-term investing. Long-term investors benefit from the actual growth of companies, from dividends, from that compounding we talked about. Active traders, they're constantly fighting market noise, transaction costs, and crucially, their own emotions. A disciplined buy and hold, long-term approach just drastically shifts the odds in your favor.
Wow, 95% losing money. That really puts it in perspective. Okay, let's talk about mistake number 8. These are like the silent killers of returns, ignoring costs and taxes. These things can just quietly chip away at your profits over the years. You might not even notice them at first. Think about brokerage fees every time you trade, or the expense ratios on mutual funds. That's the annual fee the fund company charges. And then, of course, taxes on your gains. Our sources had a really eye-opening example, a mutual fund with just a 2% higher expense ratio compared to a lower cost one. Over 20 years, that difference could add up to 1 crore rupees. That's 10 million rupees, a huge amount of money. Those seemingly tiny percentages really compound into massive differences over time.
It's amazing how often people overlook this. They just focus on the headline return number, the gross return. The solution is just be mindful. Be aware of these costs. Choose low-cost options when you can. Index funds, for instance, passively track an index like the Nifty or S&P 500. They inherently have much lower expense ratios than actively managed funds. And think about taxes as part of your strategy, not an afterthought. Using tax-saving options like ELSS funds in India, those are equity-linked savings schemes with tax benefits. Or simply holding investments long enough to qualify for lower long-term capital gains tax rates. That can significantly boost your actual take-home returns.
Those hidden costs really do add up. Okay, mistake number 9. This is a very common and very damaging reaction when things get scary. Stopping your SIP during a market crash. It's totally natural, right? Market tanks, fear kicks in, it's scary. And the instinct for many people is just hit pause, stop those regular SIP investments. But actually, that's precisely the wrong thing to do. Think of it like this. A market crash is basically a sale season for investments. Everything's marked down. Our sources pointed out that people who kept their SIPs going right through the big 2008 crash, they saw their investments triple by 2018. Triple. It feels counterintuitive, but buying consistently when prices are low is exactly how you build serious wealth over the long run.
This really highlights investor psychology, doesn't it? The gut reaction is almost always to run for cover when things look bad. But the logical strategic move is to keep going, maybe even invest more if you can during those downturns. Because when prices are depressed, that fixed SIP amount you're investing, it buys way more units, more shares. That's the power of rupee cost averaging really kicking in. It's incredibly effective when markets are choppy. Sticking with it. Maintaining that discipline during crashes. That's honestly one of the biggest things separating successful long-term investors from the rest.
Such a powerful lesson. Go against the instinct. Okay, finally, mistake number 10. And you could argue this one underpins almost all the others. A general lack of patience and discipline. This might just be the biggest one overall. People invest, they expect huge returns in a few months. And when it doesn't happen immediately, they get discouraged, they give up. But building real wealth in the market, it's an endurance race, it's a marathon, definitely not a sprint. Our sources reminded us of companies like Asian Paints, HDFC Bank, big names in India. The people who really made fortunes, became crepidous millionaires in the Indian context, were the ones who held on for 20 years, 25 years, or more. It's just a testament to sticking with it, unwavering commitment.
Yeah, and what's often missed is, while we talk about specific strategies, index funds, SIPs, the qualities you really need, the overarching things are patience and discipline. They aren't just buzzwords, they're the bedrock. You need the discipline to actually stick to your plan. The plan you made when you were calm and rational. Stick to it even when the market is going crazy, up or down. Ignore the noise, the fads. And you need the patience to let it work. Let compounding do its thing over decades. That's where the truly transformative growth happens, turning small, consistent efforts into something substantial. Life-changing even.
Wow. Okay, that was a really thorough deep dive, wasn't it? We covered a lot. Let's just quickly circle back to that core idea we kept hitting on. The real secret to successful investing. It often seems to be less about what you do, chasing that hot stock or perfect timing, and much, much more about what you avoid. Just by sidestepping these common mistakes we talked about today, like not having clear goals or blindly following tips, trying to time the market, not diversifying properly. You're not just improving your odds. You're actively building a stronger foundation for your whole financial future.
Yeah, and we saw how ignoring that emergency fund can force you to sell at the worst time. How short-term thinking just completely misses the power of long-term growth. How getting overconfident leads to churning and costs. By just being aware of these traps, by showing that patience and discipline, by refusing to panic and stop your SIPs when the market gets rough, you really can automatically improve your returns. It's the power of, conscious avoidance, intelligent self-control maybe. So as you think about our deep dive today, what really stood out to you?
Maybe you recognized a mistake you've made before, or even better, one you now feel equipped to avoid going forward. We really hope you take a moment, reflect on your own habits, and see how these insights might help you make smarter choices. And just as we wrap up today's deep dive, here's a final thought to maybe chew on. The market's always going to throw new opportunities, new trends at us. That's constant. But perhaps the ultimate market secret isn't finding the perfect stock pick, or even the right sector, maybe. Maybe it's actually understanding your own psychology, your biases, your fears, your impulses, and then combining that self-awareness with a real commitment to keep learning. Making smart choices not just about what you invest in, but about how you approach investing overall. That maybe is the deepest dive of all.